You know what's wild? Every time the market crashes, people act shocked, like they just witnessed a lightning bolt from a clear blue sky. Nobody saw this coming, they say, while sipping overpriced lattes, scrolling through headlines that screened warnings from months. Let me tell you a secret that's not actually a secret. Most financial disasters are not surprises. They're slow-motion car wrecks, loud, obvious, and entirely predictable to anyone who wasn't hypnotized by hype. The real issue? People don't miss the signs, they ignore them. Because if you see them, you have to act. And acting is uncomfortable when your Uber driver is making 10x on meme coins and your aunt is pitching real estate flips at Thanksgiving. I've lost count of how many people ask me, how do I know the exact moment to sell before a crash? That's the wrong question. That's like standing in a burning building and asking, when should I jump out the window for maximum air time? The better question is, why the hell were you still inside when the smoke alarm had been going off for weeks? We live in a culture that rewards short-term excitement and punishes boring discipline. So of course we're drawn to the drama. But if you want to survive, not just financially, but mentally, you need to let go of the fantasy that crashes are freak accidents. They're not. They're the final scene in a movie that started with greed, denial, and too many people thinking they're financial geniuses just because the numbers on their app keep going up. Crashes aren't random. They're not lightning strikes or acts of God. They're the final invoice for years of reckless behavior. And the invoice always arrives, usually later than expected, but always louder than anyone wants to admit. The root cause? Human nature. Not algorithms, not black swans, just plain old greed, self-deception, and the magical thinking that comes when people confuse short-term rewards with permanent truths. Add some leverage on top, and you've got the perfect cocktail for collapse. Take Evergrande, for example. For years, it was China's poster child for growth. Shiny towers everywhere, money flying, investors grinning. But underneath the glamour, a mountain of debt, fantasy-level accounting, and a business model that only worked as long as nobody asked tough questions. People ignored the obvious cracks because acknowledging them would mean facing uncomfortable truths, and nobody wants to be the party pooper at a profit orgy. This is how it always goes. People see the signs, they smell the smoke, but they keep dancing because it feels good, and everyone else is still dancing. And then it breaks, fast, not because the information wasn't there, but because nobody wanted to act on it while the music was playing. Most market disasters are just the consequences of ignoring obvious warnings. The danger isn't lack of data, it's the refusal to process reality when reality is inconvenient. It's easier to ride the wave and pretend it's all genius until the tide vanishes and you're standing there holding air. One of the loudest alarm bells in any bubble is when everybody suddenly becomes an expert. I'm not talking about fund managers or analysts. I'm talking about your dentist giving you stock tips while adjusting your crown, your barista quoting crypto charts while steaming oat milk, your cousin who just learned what a dividend is, now running a TikTok account called Wealth Wizard. When markets are rational, finance stays mostly boring. When it turns into entertainment, it's time to get nervous. Real investing is slow, it's quiet. But bubbles? Bubbles are loud. They're full of swagger, hot takes, and people making six-figure bets based on YouTube clips and Reddit threads. This kind of crowd participation feels exciting, but it's actually dangerous. The more people pile in, the less anyone thinks. It stops being about value and starts being about vibes. And vibes don't protect you when gravity kicks in. If you're surrounded by people who never cared about markets suddenly talking like fund managers, that's not a revolution, that's a warning shot. Another classic sign of a bubble is when valuation stops mattering. You start hearing things like earnings are old school or this is a whole new era, bro. People toss out basic math like it's some relic from the Stone Age and replace it with vibes, momentum, or some made-up metric like daily active users or engagement velocity. And the deadliest phrase of all, this time is different. Every market disaster in history has been built on those four words. It's the anthem of the overconfident. It whispers that the old rules no longer apply, that we've reached some magical place where trees grow to the sky and stocks only go up. The moment people stop asking, what is this actually worth, and start asking, how high can it go, you're no longer investing, you're gambling, and the house always wins. Valuation isn't boring, it's reality, and reality always shows up, eventually. Leverage is like fire. It can cook your dinner or burn down your house. And in bull markets, people treat it like magic. Why not borrow to invest? Prices keep going up, right? Debt feels smart when it works, until it doesn't. Here's what leverage really does. It multiplies everything. Gains, losses, emotions, stupidity. It turns a bad day into a margin call. It turns a correction into a collapse. And it turns smart people into forced sellers at the worst possible moment. The worst part? Most people don't realize how deep in they are until the floor disappears. They borrowed on margin, they leveraged crypto, they financed real estate with zero cushion, and then boom, prices drop, panic kicks in, and now they're not just losing money, they're getting liquidated. Leverage doesn't just raise the stakes, it removes your ability to stay in the game. That's not strategy, that's suicide in slow motion. You know it's late in the cycle when garbage starts leading the parade. The worst companies, the ones with no profits, no products, no plan, suddenly become market darlings. They're not winning because they got better. They're winning because speculation has run out of quality targets and started chasing whatever still moves. At this stage, it's not investing anymore. It's not even intelligent gambling. It's just raw desperation, dressed up in hype and hashtags. People aren't buying value, they're buying dreams. And when dreams start outperforming reality, you should start paying attention. The market turns into a casino, and the loudest voices are the ones selling lottery tickets. You see it in low-float junk stocks skyrocketing for no reason. You see it in meme tokens that are literally jokes, except people are mortgaging their futures to chase them. When trash is outperforming quality, the music is about to stop, and the people still dancing won't hear the silence until it's too late. Right before a crash, everything feels calm. Too calm. Volatility drops. Every dip gets bought. The media spins every setback as transitory. People start to believe that bad things can't happen anymore. because, hey, didn't the Fed save us last time? This illusion of safety is what makes the fall so brutal. When you believe you're invincible, you don't protect yourself. You stop asking questions. You take bigger risks. You start assuming someone will always step in to fix things before they get ugly. But here's the truth. The more people believe there's a safety net, the more reckless they become. And when enough people act that way at the same time, that safety net disappears. Complacency isn't a soft landing. It's the last inhale before the plunge. When the fall begins, logic leaves the room. Prices drop, and suddenly no one cares about fundamentals. It's no longer about what something is worth. It's about how much pain people can tolerate. They don't sell because the asset is bad. They sell because they're scared, because watching red numbers bleed across a screen triggers something primal, fight or flight. And most people, they run fast, right at the worst possible moment. This is when good investors destroy years of smart decisions in a few panicked trades. It's not about IQ, it's about EQ, emotional control. If you weren't prepared before the storm, now is not the time to build a shelter. Now you're exposed, naked, vulnerable, and the market is not gentle. It punishes emotion. It feeds on panic. The irony? Crashes aren't fatal. Selling in fear is. You don't need to call the exact top. You don't need to be a market timing wizard. You just need to recognize when things are insane and start pulling back before the music stops. That means trimming risk when greed is loudest. That means stepping aside when the party feels too good to be true. It means being willing to look wrong while others are still popping champagne. Everyone wants to feel smart in the moment, but real survival, that comes from being early, not perfect. It comes from making boring decisions that don't impress your friends, but keep you in the game. You win this game by staying alive, not by playing hero. If you want to survive chaos, build resilience before it hits. That means holding cash even when it feels stupid. It means choosing boring, high-quality assets over flashy promises. It means avoiding debt, especially the kind that feels safe. Cash isn't laziness, it's flexibility. It's your seatbelt when the ride gets bumpy. When others are forced to sell, you can stay calm, or better yet, buy. You also need rules. Not complicated ones, just clear boundaries you set when things are calm so you don't panic when they're not. Decide in advance how much risk you're willing to carry. Decide which assets you'll never touch, no matter how hot they get. And above all, prepare your mind. Imagine the crash before it happens. Imagine the fear, the headlines, the noise. If you've rehearsed it mentally, it loses power over you. Survival is not about being the smartest. It's about being the most prepared. Markets don't reward brilliance. They punish stupidity, especially the kind that comes dressed as confidence, leverage, and FOMO. The winners aren't always the smartest. They're the most disciplined, the most patient, the ones who play the long game while everyone else is chasing dopamine. You don't need to predict the future. You just need to avoid obvious mistakes. You don't need perfect timing. You just need emotional control. You don't need to beat everyone. You just need to survive long enough for compounding to do its quiet magic. Crash cycles will keep happening. They always have. The question is, will you recognize the signs? Will you have the courage to act when everyone else is celebrating? Will you stand still when the crowd is running? That's the real edge. Not IQ, not timing, temperament.